Welcome to PhillipCapital's Weekly Market Watch. We saw Asia fall 7% over the last month, and why was it so? Let us find out from Mr. James Chua, investment analyst from PhillipCapital Management. So James, what were the main drivers of this sell-off?
Yeah, the two main things that we've noticed that has driven the sell-off is actually the revision downwards in terms of leading economic indicators and also a revision downwards in terms of consensus earnings. When the market bottomed in November, a lot of bulls were hopeful that the leading indicators would rebound and that consensus earnings would slow to the downside in terms of revisions downwards. What we actually did see towards the end of January and the beginning of Feb is you see the leading indicators actually get revised downwards as the new data points became available. Consensus earnings also got revised downwards. On the MSCI World, you see the revision downwards up to about 12%, which is the single largest monthly revision downwards since the MSCI World was incepted. So, the acceleration and downside of revised earnings certainly caused investors to become more bearish and to sell off their positions which they purchased near the November lows.
What will it take to move markets higher at this point?
Yeah, our team has identified three things which we regard as being critical. The first thing is we want to see an increase in the investor risk appetite. Number two is we want to see an improvement in the global leading indicators such as the ISM index, the Baltic Dry Index, or consumer confidence within the United States. Number three, we want to see an improvement in consensus earnings. I think the thing to pay attention to is number one, which is the increase in risk appetite. We believe that the only thing or the most effective thing and driver of number one will be policy action on the part of regulators. So far what we've seen is the market doesn't regard the Obama plan as having much punch to it. So we're in a wait and see kind of mode at the moment.
Previously, you mentioned that you favored bonds over stocks. What do you see in the bond market at the moment?
Yeah, I think what we're seeing is there's a very, very large liquidity discount in the bond markets. It's not so much a reflection of the underlying fundamentals and the high rate of defaults in the future, but more so a reflection of the lack of liquidity and the lack of buyers in the market. Also, within bond subsectors, we're seeing a lot of differentiated returns of bonds. So, for instance, in the subprime sector, spreads remain near all-time highs. In the financials, a lot of them have recovered till about October levels. Surprisingly, in consumer credit, we've also seen spreads come down from highs in October, highs in November. So we think that there's a lot of value opportunities that exist within the bond market. The bottom-up research is able to show certain sectors that have good potential going forward, and in general what we've seen is that the sectors which have a government backstop, the sectors which are government guaranteed, generally are performing better. The task for any bond investor at the moment is trying to identify which sectors in the future would enjoy that kind of explicit guarantee from the government.
Thank you, James. That's all we have for you today. Tune in next week for more market updates.